Okay, let's unpack this. You've given us a fascinating piece here on a topic that feels, well, incredibly relevant today. How to build trust when you're raising money in these complex emerging markets. It's clearly about so much more than just the financial projections, isn't it?
Absolutely. Yeah, this deep dive, it's built around an article called Building Trust in Emerging Market Fundraising. It's by Dr. Pooyan Ghamari, a Swiss economist, also the founder of the ALandPlatform. And we've also got some exclusive expert FAQs that really drill down into specific questions LPs, that's the limited partners the investors often have.
Right. So our mission in this deep dive is to take these sources and, extract the essential playbook for fund managers trying to navigate this challenging terrain. And maybe even more importantly, understand why trust is just the ultimate non-negotiable currency here, especially for you wanting to get quickly and thoroughly informed on this. We'll try to highlight the surprising facts and the practical strategies these sources lay out.
Yeah, and here's where it gets really interesting, I think. The core idea running through the material is that raising capital in these markets, it's a high-stakes game. It demands way more than just showing compelling potential returns. You're dealing with regulatory ambiguity, significant cultural nuances, sometimes geopolitical tension, all while LPs are, quite rightly, demanding transparency, predictability, and increasingly real-world impact. So the article strongly argues that systematically cultivating trust, that's the most potent differentiator a fund manager can possibly have.
Okay. And the sources break this down into several key strategic pillars. The first one really challenges traditional thinking around how managers should communicate with their investors. It's about building what the article calls the architecture of transparency.
Right. The basic challenge in emerging markets is often fragmented data,
Yeah.
scarce benchmarks,
Yeah.
and the market trajectories can feel really unpredictable. So LPs can't just rely on the familiar performance numbers or the historical data they might be used to. They need something deeper.
Which means the strategy isn't just, here are the numbers. The article says managers need to become storytellers of a deeper kind,
Mm.
moving beyond just performance talk to what's called contextual dialogue.
Exactly. It's explaining the why behind your decisions, the strategic logic,
Yeah.
laying out the socio-political landscape you're actually operating in, and articulating the genuine rationale for being in a specific market, not just, the potential returns look good.
And that implies a huge shift from the usual quarterly report and then, well, silence. It means moving to ongoing multi-channel conversations. The sources give some great examples like monthly data briefs, virtual construction walkthroughs for real estate stuff, even geopolitical insight sessions.
Yeah, exactly. And this isn't just like busy work, it builds familiarity.
Yeah.
It drastically reduces that uncertainty for the LP, and it adds that crucial human touch that you just don't get from raw data.
Which leads naturally to this idea of transparency as strategy, not just compliance. It's not about being defensive, right?
Not at all. The real value comes from sharing not only the wins, but also the vulnerabilities, the uncertainties you're facing. And crucially, your plans to fix things when they inevitably go sideways. Candor, the article stresses, is valued way more than some perfect facade, especially by sophisticated institutional investors, family offices. They want to see real-time intelligence. How you think?
That ALand example really nails it, using live dashboards for their real estate projects, showing everything from drone updates to cost modeling, stress tests. It wasn't just oversight, it let LPs feel like they were participating emotionally and intellectually, as the article puts it, seeing the reality.
Exactly. And what's fascinating here is how deeply this ties into another point that might seem less obvious at first. Understanding cultural expectations and risk psychology. This is huge and often underrated. Risk tolerance, how fast decisions get made, how trust is actually built and signaled. It varies wildly between cultures. The article mentions places like Zurich, Dubai, Shanghai, Sao Paulo, all very different approaches.
Yeah, I can see that. What's seen as agile in one place could easily look reckless somewhere else. So managers really have to localize their messaging, adapting timelines, reports, deal cadence, how they do capital calls.
Precisely. The goal is intentional respect for local norms, not just applying a one-size-fits-all global template. It shows you get it.
Okay, so building transparency, understanding cultural context, that's foundational. But even then, emerging markets are unpredictable. How do you manage the expectations around that volatility, that nonlinear growth? Which brings us to the next key area. Managing expectations, kind of friction-proofing that GP-LP relationship.
Right, and the challenge is clear. Returns here often aren't a straight lineup. not like developed markets sometimes.
Yeah.
Those initial years might just see capital going out because of local realities.
Yeah.
Regulatory delays, unexpected infrastructure issues, currency swings. If LPs come in expecting smooth sailing like back home, well, you're setting up for friction.
So the strategy is basically about education and managing perceptions from the get-go.
Exactly. You need to anchor the long-term vision by grounding it in local realities. The material really emphasizes sort of deprogramming LPs from those developed market timelines. You have to walk them through the typical investment curve for that specific market or sector. Explain the initial setup dip.
Right, the part where you're spending money.
Yeah. Then anticipate the growth inflection point and map out the eventual monetization phase. Show them the whole journey.
The real estate example is perfect for this. Instead of just showing shiny future ROI numbers, you walk LPs through getting zoning, permits, stabilizing rent. You show the hard yards before the big returns.
Absolutely. And another big friction point, common pitfall, is addressing liquidity without overpromising. Markets with thin liquidity. Well, you just can't realistically promise quick or easy early exits. It's often not possible.
So what's the alternative then?
The sources suggest offering things like tiered or milestone-based exit strategies, more creative approaches. They mention examples like setting up strategic sale options aimed at specific regional players who might see value differently, or facilitating secondary sales within local funds, or even structuring rollovers into related markets once things mature.
And that ALand practice pre-mapping the potential exit ecosystem before investing, that sounds incredibly thorough.
It is. Identifying likely buyers, government programs, listing potential. That level of foresight gives concrete reassurance, shows you thought it all the way through.
Okay, and finally in this section, how do you help LPs deal with the unavoidable volatility anxiety? News headlines can be scary.
Yeah, they can. The approach here is to guide LPs to see that daily volatility as sort of surface noise, not a reflection of the deep value you're building underneath. You build resilience by consistently sharing insights on the fundamentals, long-term demographics, consumption growth, infrastructure booms. And you just keep reiterating that for this kind of investing, the long game is truly the only game that counts if you want to capture that real alpha.
Okay, so we've talked communication and managing expectations. Let's move to how you actually structure the deals. Section 3, designing deals that speak LP, from paper to partnership. This is about crafting structures that reflect local smarts and global best practices.
Exactly. It's about designing structures that inherently align everyone's interests and provide comfort, especially in an unfamiliar setting. And one of the clearest trust signals, co-investment, showing skin in the game.
Right. LPs want to see the GP, the manager, has real money in alongside theirs, not just reputation.
Absolutely. The ALand rule mentioned is simple. Every project includes GP capital. It locks their upside directly with their partners. Shared risk, shared reward. Can't beat it for alignment.
And then you complement that with fair profit sharing, the carried interest mechanisms.
Yes, equitable carried interest mechanisms. How the manager shares profits above a certain return hurdle. You design these so LPs benefit first, including clear clawback clauses where the GP might have to return profits if things go south later, along with milestone-based distribution and transparent hurdle rates. All that stuff significantly boosts credibility. It shows you're committed for the long haul.
Makes sense. Another strategy mentioned is using conditional tranches for deploying capital. How does that work?
It's about managing risk in fluid situations.
Yeah.
You don't put all the money in at once. Funding gets tied to hitting verifiable, concrete milestones.
Like what?
Oh, things like getting a key regulatory approval, finishing a specific project phase, hitting a defined revenue target, gives LPs clear checkpoints, but still lets the fund move quickly when the time is right. It's controlled deployment.
The sources also really hammer home the need for local allies. Strategic joint ventures with local anchors. Mandatory, not optional.
Absolutely mandatory. Partnering with established local players, developers, logistics firms, infrastructure companies, it massively de-risks navigating the local bureaucracy, the red tape. Plus, it builds crucial community goodwill and can even provide some political cover.
But you have to structure those JVs carefully, I imagine.
Critically important, clear governance, performance metrics, robust dispute resolution protocols. That needs to be baked in from day one. That's your operational bedrock.
Okay, a perennial worry. Currency volatility and capital controls. Big fear for LPs. How do you address that?
You have to tackle it head-on with credible mitigation plans. The sources mention creative solutions. Hedging via returns linked to local currency sometimes, using layered debt structures with local and international finance, partnering with local banks offering cross-border transfer protection. LPs need confidence their capital can grow and be accessed reliably. The FAQs really back this up too, blending local loans, revenue-linked returns, natural hedges via trade flows, even dual currency exit options. Lots of tools in the toolbox.
Right. Shifting gears slightly, but still all about trust. Section 4 on ESG and impact. Trust building through purpose. LPs today aren't just looking at returns, they're global citizens. ESG is central now, right?
Increasingly so, yes, especially in emerging markets where the impact can be so visible. The strategy has to go beyond just talking a good game. You need to genuinely demonstrate commitment. That means embedding ESG into the entire deal lifecycle, tracking, measuring, communicating it from the due diligence all the way through reporting.
And using established frameworks adds credibility, like irises plus air, SDG alignment, getting independent impact audits.
Definitely. Those provide a common language and verification. And focusing on real assets with real, tangible impact is also smart. Things like schools, green spaces, affordable housing, they're not just nice-to-haves. They can smooth regulatory paths, attract specific impact capital, and become long-term value anchors for the investment and the community.
That ALand practice, again, integrating environmental impact reports and social contribution dashboards right into their normal investment reports, that seems powerful.
It is. It builds reputational capital, shows deep commitment, and frankly, it probably helps de-risk projects politically, too. You're seen as a partner.
Okay, but how do you actually measure that impact, especially in places that might not have great data? That came up in the FAQs.
Yeah, good question. That's where technology really helps. The FAQs suggest using tech like IoT sensors, satellite imagery, maybe mobile surveys to fill those data gaps. And crucially, bringing in third-party verification to make sure the reporting is robust and credible. You need that independent stamp.
Okay, great. Let's maybe wrap up with some quick hits from those expert FAQs, just practical advice nuggets.
Sounds good. Fire away.
What are some of those key early trust signals LPs look for in these markets?
Okay, the FAQs pointed to real co-investment, seeing the GP's money in. Detailed risk matrices showing you've thought about what could go wrong. Giving LPs direct exposure to local partners. And early transparency on things like fees, decision rights, and realistic stress-tested timelines. Those things build trust fast.
How about handling fears around political instability without sounding like you're ignoring it?
Be prepared and transparent. Embed local advisors. Put specific risk clauses in term sheets. Offer detailed what-if scenarios with clear action plans. It's about showing realistic preparedness, not pretending the risk doesn't exist.
And deal structures, do they differ for, say, family offices versus big institutions?
Yeah, the materials suggest family offices often like more control, more connection to the story. So maybe direct co-investment or JV options appeal more. Institutions, they typically prioritize strong governance and scale. So larger pooled structures, clear compliance layers, that's more their focus.
Right. We covered measuring impact in data-poor markets and handling FX risk already.
Correct.
So what are the top missteps GPs make, according to the sources? Where do they often go wrong?
The big ones mentioned were overpromising timelines, it's a classic, ignoring cultural nuances, trying to impose a foreign way of working, and trying to hide or downplay volatility. The sources were clear. Experienced LPs prefer the hard truth with a plan over false optimism.
And for emerging real estate specifically, any hot sectors LPs are watching?
Yep, the FAQs highlighted logistics parks' huge demand, data centers, workforce housing,
Yeah.
and ESG-compliant mixed-use developments, things seen as durable, scalable, and somewhat defensible.
How can digital platforms help build that trust in communications?
Utility and security are key. Mobile-first dashboards for easy access. Short, frequent site updates, maybe even video clips. Encrypted data rooms, obviously. The FAQs even mentioned exploring blockchain for immutable transaction logs, boosting credibility around deals and payments. Very forward-looking.
Interesting. And one last one, can LPs actually help with navigating tricky regulations?
Absolutely, yes. The suggestion was GPs can set up LP advisory councils. You could bring in LPs with relevant experience, regional legal experts, maybe former regulators. They offer strategic insight, not operational interference. It could be really valuable.
Okay. So putting this all together, what's the big takeaway? Fundraising in emerging markets sounds like it's way more than just a transaction. It's really a trust marathon.
That's a great way to put it, a trust marathon.
Yeah.
LPs aren't necessarily looking for perfect projections or, slick sales pitches. What they're really seeking is demonstrable competence, unwavering transparency, and a deep, nuanced understanding of the local reality and where things are actually going.
Yeah. The source material makes such a powerful point.
Yeah.
For fund managers in this space, The real lasting asset isn't just the capital they raise.
Mhm.
It's the trust they build. And trust isn't something you just claim. It has to be earned, demonstrated, through consistent actions, thoughtful deal structures that align interests, and maybe most importantly, through shared sacrifice and being upfront when things get tough.
Well said. And here's maybe a final provocative thought for you to consider, pulled straight from the source material. As developed markets potentially face slower growth, maybe even stagnation, that real potential for generating alpha, those outsized returns, increasingly lies in emerging markets. But unlocking that scalable long-term upside from demographics, urbanization, digital infrastructure gaps,
Hmm.
it only works if the fund manager is both technically competent and deeply trustworthy.
So what does that suggest about where smart investors should really be focusing their due diligence efforts? Something for you to mull over.